There are no guarantees in the world of investment, but years of experience and careful analysis can be drawn on to help shape decision-making. That's why we've asked a leading investment expert to share his view of what 2018 may have in store. Here Mark Burgess, Deputy Global Chief Investment Officer at Columbia Threadneedle Investments, takes us through the issues he believes could affect regions and sectors of the world economy, and touches on his company's strategy to overcome any headwinds. And we've also asked Darius McDermott, Managing Director of Fund Calibre, for his recommendations of suitable funds for investing along a similar approach to Columbia Threadneedle's for 2018. Mark Burgess, the global economy, with the exception of the UK, is going through a period of synchronised expansion. Corporate profits are rising, trade is increasing, and growth is robust in the US, Europe and beyond. Asia is benefiting from this global phenomenon and from a continued uplift in China. Japanese equities in particular are finding a sweet spot due to increased strength in corporate earnings and evidence of ongoing corporate reform driving better returns for shareholders. On a monetary policy level, despite the U.S. Federal Reserve raising interest rates in North America and the Bank of England raising rates for the first time in a decade, money remains relatively cheap for companies and consumers to borrow, stimulating growth. Against this backdrop, it is not surprising that share prices are at current high levels. All things being equal, we prefer equities in 2018 compared to credit, company debt, and government bonds. However, as investors we must ask ourselves, what could upset this positive outlook? There are geopolitical risks on the horizon, including Brexit, potential instability in Europe and U.S. relations with North Korea, China, and Mexico. We are also keeping an eye on inflation, where an inflationary shock could destabilize markets. We expect corporate earnings growth of 10 to 15% in 2018, supported by Goldilocks conditions of moderate economic growth, low inflation and asset-friendly monetary policy. Our preferred regions are Japan, Europe ex-UK and Asian emerging markets.We forecast corporate earnings growth of 8% for Japan next year, supported by higher-than-expected economic growth, corporate reform, receding political risk, and easy monetary policy. The commitment from a rising number of Japanese companies to improve return on equity is an important factor. Continued robust performance across the euro area is aided by strong manufacturing data and demand, while domestic consumption, a key factor for ongoing growth, has been boosted by rising employment numbers and improving household balance sheets. Confidence is high, business is buoyant, and jobs are being created at an impressive pace. And so against this backdrop we believe European corporate earnings can grow by 15% next year. but all eyes will be on the pace of the ECB's taper, the end of quantitative easing, and interest rate rises. The ECB is still buying bonds worth €60 billion a month, and, even after it reduces these flows in 2018, it is likely to be in the market for most of the year. But as the European recovery gathers steam, the ECB may well begin to question whether its easy policy stance remains appropriate. The demand for high-quality income will remain a theme. This is unlikely to change given aging demographics around the world. However, given where starting yields are today, investors are unlikely to see strong excess returns from credit markets. We have had a long-standing negative stance on core government bonds, and this has not changed. We still believe them to be vulnerable, and they are far too richly valued for our liking. Within credit, the European high-yield corporate bond market offers marginally more upside than the corporate investment-grade market. However, with yields at such low levels by historical standards, there are clearly risks that bond markets are due a correction. We asked Darius McDermott, managing director of funds rating service Fund Calibre, to suggest a top fund for exposure in Japan, Europe ex-UK and Asian ex-Japan respectively, as well as fixed income. Here are his recommendations. The Baillie Gifford Japanese fund targets growth over the long term through investment in any economic sector in Japan. Up to 10% of the fund's value can be invested in collective investment schemes and deposits. The fund has an ongoing charge figure, OCF, of 0.63% and has returned 173.95% over the past 5 years. Darius McDermott of Fund Calibre suggests funds for exposure in regions across the world as well as fixed income. Baillie Gifford have one of the strongest Japan equity teams around, and any one of their funds are worth consideration, according to McDermott. Trusts are at a quite high premium now, though, so this open-ended one is preferred. The fund invests at least 2/3 of its assets in shares of companies with what the management team deems as good growth prospects in continental Europe or companies that have significant operations there. McDermott said, "It is a great core fund with a fantastic manager. It holds positions for the long term and invests in good quality companies." The fund levies an OCF of 0.83% and has returned 89.13% over the past 5 years. For Asia, McDermott singles out the JOHCM Asia ex-Japan Fund, which invests solely in equities in the region. The fund charges an OCF of 1.03% and boasts 5-year returns of 78.28%. McDermott said, "The fund is managed by a very experienced team who have proven themselves through market cycles and the Asian financial crisis." McDermott favors AXA Sterling Credit Short Duration Fund, which targets quarterly income payments through investments in mainly sterling-denominated investment-grade bonds with a bias towards shorter maturities. The fund has an OC of 0.42% and has returned 8.99% over the past 5 years. He also heralds Baillie Gifford Corporate Bond, which aims to produce a high level of monthly income by investing primarily in a diversified portfolio of investment-grade and sub-investment-grade fixed-interest securities. These investments can be denominated in sterling or in currencies other than sterling and hedged back to sterling. The fund has an OCF of 0.53% and recorded returns of 35.11% over the past 5 years. McDermott said, AXA Sterling Credit Short Duration if you want very little interest rate risk or Baillie Gifford Corporate Bond, which is actually a strategic bond with a very good manager and which can invest across the fixed income spectrum.